Hi all, thanks for joining this webinar. Whoever attending this in Zoom, whoever attending in YouTube, thanks for your time. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N. Raja, Chartered Accountant by qualification and a teacher by passion. So just a day before completing my Chartered Accountancy, I had the opportunity of being placed in India's largest commercial bank. I joined SBI as credit analyst, worked as credit analyst for 1 year, then got elevated as team leader, credit processing cell, worked on 250 plus projects, 5,000 crore plus size, then came out and started my CA practice, had practice for 7.5 years with focus on project funding, debt arrangement, debt syndication. Parallelly, I pursued my passion. Passion is teaching. So I started teaching financial management, strategic financial management for students in and around here in Ernakulam, Kerala. Then I explored, or I should say, I leveraged technology. Thanks to technology, today I could teach several thousands of students. As on the date of recording, it's 180,000 plus students all over the world. That's the opportunity technology gave me, and that's why we are also interacting now. On the personal note, I am father of 2 children, happily settled in God's own country, Kerala. So today's topic is how to carry out term loan appraisal and assessment as banker. So it is not only for the banker, even for finance managers, project consultants, chartered accountants. If you are assisting the client or if you are part of the organization which is taking up the term loan project, then this will help you out. Okay. We are going to talk about term loan appraisal and assessment. But before that, let's understand one thing. Why business entity should go for a term loan? Okay, so I'm going to show you 2 or 3 scenarios. I'm going to show you 2 or 3 scenarios to help you to understand the importance of term loans. Number one, if they want really magnified returns and growth, they should go for a term loan whenever they take up a project. It means this is contrary to the saying that you should not borrow, you should use only own funds. No, if business they want to really make better revenue, if they want to really make a magnified returns and growth, they should go for term loan. Let me show you a scenario. Look at this. There is a project. The cost of the project is 100 lakhs. Let's say I'm taking up this project at a cost of 100 lakhs. Now I have 2 alternatives to fund the project. One is a scenario where I fund the project with 100% my own money, and second scenario is where I fund the project partly with my own money and a major portion with bank's money. Let's see how this works. So this is a scenario where I'm going to fund with a bank loan. Okay. So what is the cost of project? We know in both scenarios it is 100 lakhs. In first scenario, I'm fully funding the project with my own money. So I say this is equity funding. Whereas in the second scenario, only a portion of the project is funded by me. That is, out of 100 lakhs, only 30 lakhs is funded by me. It means in the second scenario, I'm going for a debt funding. That is, I'm going for a debt funding of 70 lakhs. Okay, now listen. This project is taken up with an understanding that this project will generate a minimum return of a certain percent. Okay, let's say this project is capable of generating a minimum return on investment of 15%. So this is the return which this 100 lakhs will generate. So this return can be technically called as earnings before interest and taxes, right? This return, what this project will generate, can be technically called as earnings before providing for interest, before providing for taxes. That is the capacity of this project. So 100 lakhs into 15% will give me 15 lakh in scenario 1. In scenario 2 also it will give me 15 lakhs. So this is what you have to understand, because this earnings before interest and taxes is like a gross profit. Okay, gross profit will give you the same amount whether you invest the project with your own money or with a combination or with full debt fund. Okay, it is the net profit that will get varied. It is the net profit that will get changed because of operation of interest cost. Okay, right. Now listen, this project is capable of giving a minimum return of 15%, that is 15 lakhs. And I said this is the earnings before interest and taxes. So that automatically means I'm yet to pay interest on loan. Let me deduct that. I have taken a loan of 70 lakh in scenario 2. And let's say that loan was taken at 10% cost. It means in scenario 1, 15 lakhs is my earnings before paying interest. From that, should I deduct any interest? Answer is no, because in scenario 1, there is no debt at all. Whereas in scenario 2, 15 lakhs is the earnings before interest. Now I know my loan is 70 lakh. 70 lakh into 10%, I have to pay 7 lakhs as interest. So from this profits, if I deduct interest, what I will get? I will get earnings after interest, or technically it is earnings before tax or profit before tax. So what is the profit before tax in scenario 1? It is 15 lakhs. What is the profit before tax in scenario 2? It is 15 lakhs minus 7 lakhs, that is, it is only 8 lakhs. Okay, so now when you look at it, the profit has come down. But how did I say that if a business goes for a term loan, there will be magnified growth? It is there. Let's understand. Now what we have arrived is profit before tax. From this, let us deduct the taxes. What is the tax amount? I'm giving you that information. It is 30% of the profit. So on 15 lakh, 30% works out to 4.5 lakhs. And under alternative 2, on 8 lakh, 30% works out to 2.4 lakhs. Okay, right. Now let's arrive at profit after tax. 15 lakh minus 4.5 lakh, 10.5 lakh is the profit after tax. Whereas in scenario 2, 2.4 lakh is the tax, 8 lakh is the profit before tax. So 8 lakhs minus 2.4 lakhs, you get profit after taxes 5.6 lakhs. Okay. Now it's time for us to measure the return for the owners. Look at scenario 1. Owners are going to get profit, or say the return for their investment of 10.5 lakhs for having invested 100 lakhs. So let me calculate return for owners. Just ignore this F by B. Okay, it's basically H divided by B. Okay, so return for owners. How much owners are getting now? They are getting 10.5 lakhs. Okay, but how much they have invested? They have invested 100 lakhs. So 10.5 lakhs as return for 100 lakhs, it means owners are getting 10.5%. They have invested 100 lakhs in this business and they're getting 10.5%. Pretty good. Okay. Now look at this. In scenario 2, what is the profit available for owners? It is 5.6 lakhs. How much owners have invested? Owners have invested only 30 lakhs. They are getting 5.6 lakhs by investing 30 lakhs. So 5.6 divided by 30, it means they are getting a return of 18.67%. It is comparatively higher, or it's better than alternative 1. It's good, right? Because they are getting 18.67% return on their investment. And how much they've committed? They've committed only 30 lakhs. It means this owner, assuming he's having 100 lakhs funds, out of 100 lakhs, he has invested only 30 lakhs in this business. It means he still has investable funds of 70 lakhs, which he can invest in a project like this combination. Okay, so that's the power of debt funding. See what happened here. Here, the presence of debt, okay, help this organization to have more return on investment for the owners. Because the same project, same assets, what has undergone a change is only the funding pattern, right? Here it was fully funded by owners' money, but here it was partly funded by owners and major portion by the bankers, or say the lenders. And if you see the profit before taxes, yes, you can see comparatively the amount is lesser. But what you have to understand is look at the amount that was invested by the owners. Amount invested by the owners is only 30 lakhs and they are taking 5.6 lakh. It means they are getting a return of 18.67%. So there is a magnified return. That's why I say, like business, whenever they take up a project funding, they should also have debt as a part of funding. Okay, debt also as a source of finance. Okay, this is reason number 1 why debt funding is required for funding a project. I'll give you one more. The another reason can be tax benefits. Whether this concept is clear for you, I mean, why business should go for term funding, why business should go for term funding when they go for a project. If this concept is clear, that is, having a debt in capital structure could result in magnified return for a business when the market scenario, market condition is good. Here, for me, I made an assumption that market condition is good. Okay. Anyone facing issue with audio? Anyone facing issue with audio? If audio is clear, type AC. I just received one or two messages saying audio, there is a problem. Okay. If audio is clear, just type AC. Okay. Then whoever having issue, that should be at your end. Okay. It could be because of internet connectivity issue. Okay. Because for majority, yes, it's going perfect. Okay, now let me just once again conclude this. In scenario one, there is no debt funding. In scenario two, it's a hybrid, a debt and equity, and the return on investment is same, cost of the project is same, but what is undergoing change here is the profits that are available for owners for the amount they have invested. In scenario one, having invested 100 lakhs, they are getting only 10.5 lakhs. In scenario two, for having invested 30 lakhs, they are going to get 5.6 lakhs. It means it is 18.67%. It is 18.67%. So there is a magnified return. But here there is an assumption. The assumption is in both scenarios, I'm saying the return on investment is same. Okay. And it also means that market condition is good. And if the market condition is not good, the term loan itself will become a bigger burden. Okay. Right. And the question from Barney Dharan, okay, I said I'll not be taking up questions now, but still I've seen this, I'll answer. In EMI, we have both interest and principal, but why we are deducting only interest? Because interest is considered as an expense, whereas the loan amount which had come into the business is not treated as income, okay? I repeat, interest is considered as expense, so we are deducting it. And the loan amount which had come in was not treated as income, was not taken to the statement of profit and loss. Rather, it was taken only for the only to the balance sheet. So if at all any repayments are going to happen, that will get reduced only from the balance sheet and not in, say, the statement of profit and loss. Okay. Yeah. So this is scenario one, and I just wanted to confirm whether this concept is clear for you. That is, having a debt fund in the capital structure could result in more return for the owners in good market condition. Within quotes, good market condition. If this concept is clear, can you type CC, concept clear? CC stands for concept clear. Yeah, please. In bad market condition, this interest is a fixed cost. This will act as an axe. It could even cut the head of the business which are not performing well, because in bad market condition, this 15% return on investment may not be possible. Instead of 15 lakhs, if they make only 10 lakhs or 5 lakhs, then that will have impact on the profits. That will have impact on say the repayment, all those. Okay, right. Let me give you one more reason why term loan should be considered for project funding. I'm taking the same scenario what we discussed. Okay, these are all the same figures, and all this we calculated. Okay, now you see, look at the scenario one. What is the tax amount? 4.5 lakhs. Look at the scenario two. What is the tax amount? It is 2.4 lakhs. Projects giving same return on investment, 15 lakh. But for the first project, tax is 4.5 lakhs. For the second project, the tax is 2.4 lakhs. It means it looks like penalizing the owner for having invested all his money. This guy invested all his money in this project. He didn't borrow at all. And so he is asked to pay 4.5 lakhs. But this guy had invested only 30 lakhs. Okay. And he is getting benefit out of it because he's paying only 2.4 lakhs. Okay, it's not because he invested only less, it's because he borrowed. Because when he borrows, he pays interest, and interest is considered as a tax deductible expense by income tax authorities. It means when my business has made a profit of 15 lakhs and when I pay interest of 7 lakhs, I can claim this interest as expense. I can tell my tax authorities my profit is not 15 lakhs, I have paid interest of 7 lakhs, so my profit is only a net of 8 lakhs, and they will consider that as profit, and only on that 8 tax will be levied. But in scenario 1, my profit is 15 lakhs, I have no other expense, so my entire profit of 15 lakhs is subject to tax at the rate of 30%. So by having the presence of interest in my cost structure, what is happening? My profits are comparatively lesser, and so my taxes are. Look at here, instead of 4.5, I'm paying only 2.4. It means there is a tax saving of how much? 4.5 minus 2.4, that is 2.1 lakh. And the beauty side is this 2.1 lakh from where I made the saving. One understanding what I have is the presence of interest. Yes, it is presence of interest, because look, 7 lakh is your interest. What is the tax rate? 30%. 7 lakh into 30% is 2.1 lakh. Are you getting this point? Having interest in your cost structure will help you to save taxes. Just take that interest amount, multiply by the tax rate. In our case, I took 7 lakh, I multiplied it with the tax rate of 30%. I derived 2.1 lakh. Now I'm comparing it with the similar scenario. If there is no interest, I would have paid 4.5 lakh. Because of interest, I'm paying only 2.4 lakh. So I have saved 2.1 lakh, which is nothing but the result of interest. Could you get this point? If this point makes sense for you, just type MS. Just type MS. MS stands for makes sense. Okay, this is something many entrepreneurs miss out. Many bankers also miss out. I mean, you can educate your customer like when they look at the interest as a burden, interest as an expense, tell them that, see, on one side you are saving taxes. Otherwise, you would have paid, you would have ended up in paying more. When you pay interest, there is one good thing: you get an immediate benefit, right? Because when you pay interest, you have borrowed, the money is in circulation. When you pay taxes, you get nothing. Of course, you enjoy the social infrastructure of the country, which is a common benefit. But when you pay interest, you get loan money, which is a personal benefit. Okay, this is a direct benefit. Okay, so this is the second reason why business should go for term loans when they take up a project. And let me give you one more reason. uh, Having interest, I mean, having borrowed funds actually results in lowest cost of funds for the business. How? Let me continue with the same example. We have seen that interest amount paid is 7 lakhs on one side. But what is the tax saved on the other side? That is, on one side, the business is paying interest at the rate of 10% on 70 lakhs loan, that is 7 lakhs. But we have also understood that on the other side, they are saving a tax of 2.1 lakhs. So on one side, I pay 7 lakh, and on the other side, I save 2.1 lakh. It means I can say my net interest cost is only 7 lakh minus 2.1, that is 4.9 lakhs. My net interest cost is only 4.9 lakhs. And what is the loan amount I have taken? 70 lakhs. For having taken 70 lakhs, I am paying interest as 4.9 lakhs. It means my effective interest cost, my actual interest cost, I know it is 10%, but my effective interest cost is 4.9 lakhs over 70 lakhs. It is only 7%. Because when you pay interest on one side, on the other side, you save taxes. So you have to see the net of it. Because if you don't pay interest, you would have paid more taxes. So because of interest only, you are saving the taxes. So net it. I pay 7 lakhs on one side, I save 2.1 lakhs on the other side. It means my net effective interest cost is only 4.9 lakhs, and I have taken a loan of 70 lakhs. So my effective interest cost is only 7%. Okay, if this is cool, I mean, if you feel this concept is really cool, just type cool. Okay, this is something which you have to understand, because this goes into management decision making. Okay, this is basically part of management accounting. People at the top level, CEOs, CFOs, they look at it in this range. Okay, they look at it in this range. I mean, they look at what is the after tax cost. They do not primarily or blindly look at the apparent cost. Okay, right. Next, Okay, next we are actually getting into the appraisal process. We are getting into the appraisal process. So I wanted to give three scenario because it stresses on the importance of term loan, because term loan is not a mere money that is coming into funding the project. It has several other side effects. The first side effect what we have seen is a magnified growth, right? The second side effect is savings in tax, and third side effect, all are positive effects, right? The third side effect is your overall interest cost is lower. Okay, these are all positive side, but the negative side is when the market downs or when the business, the unit is not performing well, then this term loan itself will act as an axe and kill that business. That's how many NPAs are being created. Okay, right. So today, uh, our 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 topic is term loan appraisal and assessment. So term loan, in the sense, I'm not going to talk about normal business loans which are given for 3 years, 5 years, 10 years without looking into the purpose. Term loans are the loans which are given for a, say, a term period, let's say 3 years, 5 years, 8 years and all. Number one. Number two, it is given for a specific purpose. It means out of that purpose, cash profits will be created, and that cash profits will be used for repaying the loan. Okay, so I repeat once again, term loans or long duration loans. Okay, so we say a term period. It is given for a specific project or a specific purpose, and that project would in turn result in either creation of sales, additional sales, or it would result in reduction of cost. Okay, so either sales or additional sales or reduction of cost. So in turn the profits will be created or additional profits will be created, and from that profit we arrive at cash profit, and with that cash profit the loan will be serviced automatically. It means we are not talking about general business loans, general corporate loans. We are talking about loans which are given for putting up a project. The project can be, say, putting up a small factory, or say constructing factory building, purchasing plant and machinery. Okay, all these projects are with an intention to either start a new business or expand an existing business, or a diversification or a cost reduction or a modernization projects. Okay, so in term loan, what is more important is you have to arrive at the exact cost of the project, and then you have to decide the means of finance. This is the quantitative part. But before getting into the quantitative part, the qualitative part of the term loan, that is very important. Okay, before going deeper into the numbers, before going into the technical analysis, as a banker, you should study the customer. Okay, understand his integrity, whether he is a man of word, whether he will repay the loan or not, what is his market reputation, okay, what was his past track record. Okay, this is the due diligence which you have to do for each and every loans. But when it comes to term loan, when he approaches you for putting up a project, you have to study that aspect in addition, whether he is capable of implementing this project. Not only implementing, whether he is capable of taking this project for the project period so that term loan will get repaid without difficulty, whether he has got that managerial capability, whether he has got that technical expertise. Okay, all those qualitative aspects you have to take into consideration. Without that, there is no point in getting into these financials or analytical aspects. Okay, so it's like sometimes the appraisal part, the quantitative appraisal part is given, or it's overemphasized, ignoring the critical qualitative parts. Okay, I mean basically the management, the integrity, their technical expertise. Okay, you have to frame an opinion by having a deeper discussion with the customer, then come for this, then come for this. I mean, I'm not saying that this is not important, but that is even more important. This is critical, okay, but that is even more important. Study your customer first, understand their mindset, understand their integrity. Okay, look at their past track record, their knowledge level, their technical expertise. Okay, if you are okay with that, then go ahead with the other aspects, technical aspects of the project. Okay, the first thing is you have to freeze the cost of the project and means of finance. I'll take you through an example. Okay, look at this. Okay, this is a typical format. This is a typical format of cost of project and means of finance. Let's say I want to start a project, let's say starting or putting up a factory and purchasing plant and machinery and installing it. So basically I'm creating the infrastructure for starting my business. So in that case, I have to invest on land, then I have to construct the building, I have to purchase and install plant and machinery, then some additional small items comes here. I'll explain what are all this as we progress. But these are all the items which I have to create to kickstart my company. And for this, I need money, right? In order to create all this, I need money. So as a owner, I'll be bringing some money. And this is something what you will see only in the companies which are profit making, existing profit making companies. I'll explain at appropriate time. Then for the balance portion, I go for a term loan. It means this table is very important for my project. Where and all I have to spend, I have to spend on land, building, plant and machinery and other items, miscellaneous items. And for all this, from where I will arrange money, how much I'm going to bring, how much I'm going to ask bank for a loan. Okay, that gets captured in cost of project and means of finance. It's something like a balance sheet. Okay, balance sheet will have like sources on one side, uses on the other side. Here I've just kept the uses on the left side and sources on the right side. Okay, any side as you wish. Okay, now let me take you through an example. Look, I'm going to start a project at a cost of 10 crore. And this project comprises where I purchase a land for 1 crore, and on that I construct my factory building for 3 crore, and I have to purchase and erect and install plant and machinery for 6 crore. So my total cost of the project is 10 crore, and how I have planned to fund this is I will be bringing in 3 crore, and I will go and approach a bank for a term loan of 7 crore. It means I'm contributing 30% for the project, and I'm asking a loan of 70%. Okay, so you can also arrive at the project debt equity ratio here. The debt is 7 crore divided by equity of 3 crore. That gives you project debt equity. Okay, so this looks like very simple, but the point is it is actually simple. It is not comprehensive, because when you finalize or when you freeze a cost of project and means of finance for a company, especially for a new project, you have to be very careful, because for this project there is no past. Okay, because it's a new project, it's a new company, new project. They don't have past. It's like a baby. Okay, so you have to take, or you have to give that maximum care so that you can ensure this grows appropriately or in correct phase. If you don't give that due care when you give birth to a new project like this, in a short period it will die. Okay, and it will uh, come as a big headache for you at a later point of time. I hope you are getting my point. If a company is starting a project, let's say a new company is starting a new project, then it's like handling a baby. Okay, you have to take utmost care to ensure that whatever is required is given. I mean, whatever the feeding is required, that have to be done. If it is not done, then this baby will collapse. Okay, shall I proceed whether everything is perfect? Just type go ahead, GH or GA. Just type go ahead. It's basically to ensure that we are all connected, the audio and video, everything is correct. Yeah, thank you. Okay, so this is the project, and this is what I'm showing to my banker, and the banker is also finalizing, but it should not be finalized in this way. Okay, here, even though we have concluded the cost of the project as 10 crore, we are missing on something. We have to take care of that. What is that? Let's see. The first one is, please provide working capital margin. Please provide working capital margin. Before that, I'll make a disclaimer here. See, this is a project at a cost of 10 crore. Okay, right. And I have 3 crore with me, and without the bank loan of 7 crore, I cannot take up this project, because the maximum funds what I have now is 3 crore. And if at all some small plus and minus is required, I can manage, but I cannot independently take up this entire project on my own. So I need a minimum term loan of 3 crore. I have brought in sorry, I need a minimum term loan of 7 crore. I have already brought in 3 crore. Some small additions is manageable. It means there will be corresponding reduction in loan if bank says so. Okay, but if the bank is generous to give this entire 7 crore, I'll be happy. Okay, so this is the background. Now I have this project, and let's say my first customer drops in, and he is ready to place order. He's ready to place order, and he's actually placing the order. So that's where my headache starts, because I have set up this project, and when a customer places an order, I have to execute that order. For that, I have to purchase raw material. For that, I have to engage my laborers. I have to incur manufacturing expenses, and whatever the fund I had, close to 3 crore, I have invested in this project. How will I manage? And that's where we say, don't worry. When the bank has given a term loan, they will also give working capital. Okay, fine. So bank is also ready to give me working capital. Okay, that's the scenario I'm going to show here. Okay, this is what required for my initial operations. I mean, if I want to kickstart my operations, I should have investment in raw material at least 1 crore. I should make investment in labor at least 50 lakhs. I should invest in other manufacturing expenses at least 50 lakhs. It means I should make additional investment of 2 crore. See, already what is my total investment? 10 crore. But now to kickstart my operation, I have to invest another 2 crore. But already I said I have only 3 crore. Maybe a small addition here and there I'll be able to manage. But a total amount of 2 crore I cannot manage. Okay. Okay, that's, we need not worry, because that's where the bank will also step in, because the bank which is giving a term loan for a project to take off should not shy away from working capital. If they are doing so, it means they are trying to give slow poison for themselves. What is the point in forming a company? I mean, what is the point in giving a term loan to a company to put up a project and saying no for working capital facility? It's like constructing a full building and saying that you will not give electricity connection, or it's like constructing a full building and saying that you will not give water connection. What is the point? Okay, never ever, as a banker, never ever have that policy. Okay, so if you are giving a term loan for putting up a project, for starting a project, then it is equally your responsibility to ensure that they are given adequate oxygen, adequate water, or adequate electricity in the form of working capital facility. Okay, so here what we have understood is they need at least another 2 crore to kickstart their operations. And let's say banker have agreed to give 75% of it. So out of 2 crore, the banker is giving 75%. Banker is ready to give 75% of it. It means the condition placed by the banker is, we will give 75%, you please bring 25%. That's what you see this 0.5. It means 25%, 50 lakhs out of 2 crore should come from the owner, and 1.5 crore bankers are ready to give. But here you should also empathize with the customer. Already that customer has managed or had so much of difficulty to bring this 3 crore, and now you are saying, or you are asking him to bring in another 50 lakhs. How he will manage? Because repeatedly I maintained that some small additions here and there with the 3 crore is manageable, but big amount is difficult. Okay, this is something which you have to relate with reality also. Okay, this would be the situation of most of the borrowers. Okay, so our banking system has recognized this difficulty. Okay, that's why our banking system is ready to consider this 50 lakh, basically the margin which the borrower should bring in for meeting the working capital facility. Our banking system is ready to consider this 50 lakhs working capital margin also as cost of the project. So already we have seen cost of project as 10 crore, right? Now with that, I'm also adding this working capital margin as cost of the project. So my cost of project will become 10.5 crore because I've added 0.5 crore. So 10.5 crore. In that, as a owner, I will bring 30%. Okay, so now 10.5 into 30% is 3.15 crore. Earlier it was 3 crore. Now I'm forced to bring 3.15 crore. Okay, there is addition of 15 lakhs, but I'm ready to do that because bank is helping me to fund what I am supposed to contribute. In this point, I am supposed to contribute 50 lakhs, but bank is ready to contribute. Bank is ready to consider that as a cost of a project, and bank is taking my load of contributing this 50 lakh, they are actually contributing how much? 35 lakhs, because 15 lakhs comes from my hand. And look at the term loan, it has become 7.35 crore. It means bank is contributing 35 lakh. Okay, so this is a concept which are overlooked by many of the bankers, and I can relate with some scenarios, some real life scenarios where the business units which were denied of this working capital margin, they had greatest difficulty in taking off. Okay, greatest difficulty in taking off. And I've seen cases which have achieved quick mortality, that is having sanctioned a term loan but not structuring the working capital facilities appropriately. Those term loan accounts have turned out to be a non-performing asset within a period of 2 to 3 years, because they were not given adequate oxygen, adequate working capital. Okay, so this is the concept of working capital margin, which should be considered as part of cost of project. So if this concept is new for you, just type new. And if it is something you are exposed for the first time, and if it's something that has opened up your mind, just type bulb on. If it is something which has opened up and you feel like yes, you have learned something new today, just type bulb on. I want to see how many bulb on we have. Yeah, great. Okay, so never ever, I mean, even if the customer, because customer will be ignorant of this, customer will not know. First of all, he'll not even know the concept of working capital. When they come to your bank, it's gradually they get to know about this. Okay, so in the initial stages, they won't even understand working capital. Then how they will understand working capital margin? So it's your responsibility to educate the customer. Okay, when you educate the customer, you will also love your process. Okay, see, the message is like this: if you want to really learn something, teach. If you want to really learn something, teach. Because there is a pyramid for learning. Okay, when you listen to lecture, when you listen to a lecture, there is a certain percentage of learning happens. When you read books, a certain percentage of learning happens. Okay, so that pyramid goes, and if you look at a point where you will have the maximum learning is when you teach. Okay, I mean, your learning will be 90% more effective when you teach. So these are all something which wherever, whenever you find an opportunity to educate your customer, educate them, and they will remember you for lifetime, number one. And you will remember this concept for lifetime. Okay, shall I go ahead? Shall I go ahead? Just type GA. It's permission from your side so that I can continue the presentation. Yeah, thanks a lot. Okay, so now we have freezed the cost of the project as 10.5 crore. But again, it's a new company, I said, right? New company, they're putting up their project for the first time. And we should not freeze the project cost at this point, because this business would have incurred some expenses even before forming this company, but for the purpose of forming this company. Let's say the incorporation expenses, or they would have done some market research, they would have done some field survey, but all are incurred for this business only. Okay, so that should also be considered as part of cost of project, and our banking system recognizes that as well. So let me put that here. Let's say I have incurred some expenses like 25 lakhs in feasibility report, 15 lakhs in market survey, then flotation cost, the cost incurred by me in starting this business. Okay, 10 lakhs. It means I have spent 50 lakhs even before I make any revenue. Okay, or 50 lakhs even before I commence my operations. So who will fund this? Already for the land, building, plant and machinery, 3 crore is gone. Then probably I would have spent this money, but I need this back to reinvest in the business, because that 3 crore what I have planned have to be invested over a period of time. But out of the 3 crore, some portion already I would have invested. It means I will face a shortage of funds in fulfilling my promise, because as per the earlier stand, as per the earlier stand, I'm supposed to, oh, sorry, yeah, as per the earlier stand, I'm supposed to bring in a capital of 3.15 crore. But this 3.15 crore is for meeting a portion of all this, right? But out of this close to 50 lakhs already I've spent. It means I will not be having 3.15 crore with me. I'll be having an amount of 50 lakhs lesser than 3.15. Okay, so that means when it comes to the compliance of this capital bringing in, there will be an issue, because the bank will not give loan amount entire 1 crore for purchasing land, because bank understands 30% is the margin. So what the bank will do, if I have to pay 1 crore for purchasing the land, bank will give me check for 70 lakhs, and bank will say, okay, you are supposed to manage 30%. No, okay, you manage. Then for building, bank will not give entire 3 crore. Bank will give check only for 2.1 crore, 70%. It means remaining 90 lakhs I have to manage. And for plant and machinery, once again, bank will not give entire 6 crore. They will give only 70%. It means balance I have to manage. But at this point, we'll get that realization that that balance may not be manageable, because I have already spent them even before starting this company, or even before commencing the operations. It means at that point I will face mismatch, and my business, my project should not suffer because of that. And that's why our banking system has to recognize they are considering this preliminary and pre-operative expenses also as part of cost of project. But this approach can vary from bank to bank. But public sector banks who want to be really conservative, they actually take care of this, because this is something which got to be provided. If it is not provided, that business, that term loan, that project will suffer. Okay, so already we had 4 items including working capital margin. With that, now I am adding preliminary and pre-operative expenses of 0.5 crore. So what is the total now? 11 crore. Out of 11 crore, 30% from owner. It means earlier it was 3.15 crore. Now it had become 3.3 crore. It means, yes, it's my responsibility, because here I'm not I mean, here I'm not put into the burden of managing this entire 50 lakhs. I have to manage only 15 lakhs. 35 lakh bank is going to support me. Look, earlier, what was the term loan? Earlier term loan, it was 7.35 lakh. Now with 7.35 lakh, another 0.35 lakh, it means bank is supporting me via term loan. So in this way, this preliminary and pre-operative expenses is also getting included in cost of project. And this aspect comes into picture only for new businesses. Okay, because preliminary, pre-operative, these expenses are applicable only for the new businesses, not for existing running business. Okay, right. The next one, this is very, very important. And again, I see like several private bankers, they just go blind on this. They just go blind on this. But if you really want to nurture a baby in appropriate form, or in the correct or right form, you have to provide for this. That is contingency, because we are dealing with future, right? The term loan is basically a project. This project is being implemented. So some projects can be very simple project, like just purchasing plant and machinery, simple, not an issue. But some project will have a longer implementation period. Okay, if you start the project today, it will take at least another 1 to 2 years to have that project completed. So in this 2 years, anything can happen, any change can take place, market can go up, it can come down, the prices of the components of the project, the price of the land, the building, the plant and machinery, several things can undergo a change. Who expected a situation like this we have now, the COVID, the lockdown? Okay, how many business units have expected a fall in sales in this period? So the market scenario can go in any direction. And when it comes to finalizing the cost of project, we have to anticipate these kind of possible negative impact, especially on the components of the cost of the project. Look at here, the land cost, sorry, yeah, the land cost is 1 crore. Okay, as far as the land, since it is a one purchase, I do not expect any major change, because when they have identified the land itself, they would have made an agreement. So there is not likely to be any major change in the price of the land. But building, I have to construct it over a period of time. And in this period, there are several factors where we will not have control, say in the price of sand, the price of cement, in the availability of laborers or cost, or there can be interruption because of monsoon, there can be interruption because of a situation like COVID. So because of this, the implementation period will get elongated, and as a result, the cost what we have estimated will also go up. Okay, several factors are there and which are mostly beyond our control. And look at plant and machinery also. Plant and machinery 6 crore. Generally they will give a pro forma invoice, and that pro forma invoice will be valid only for a certain number of days, let's say for 60 days or 90 days. But if the project implementation itself takes a longer time, and if the plant and machinery have to be purchased and installed after 6 months time, 9 months time, and in between period if anything happens like a scenario what we have now, then again the cost of those assets, plant and machineries, will also undergo a change. Okay, so out of these items, that is land, building, plant and machinery, working capital margin, preliminary expenses, on two items, mainly building and plant and machinery, there is a possibility the cost will undergo a change. It can undergo a change on the negative side, in the sense it can increase. So I am anticipating a 5% increase in this cost. So 9 crore is the total cost. I anticipate 5% increase. So that 5% increase I want to provide in the cost of the project, because had I known them in advance, then I could have provided that in the cost of building and plant and machinery itself. But I'm not sure whether it will happen or not. So it is contingency only. If at all it happens, yes, that will be taken care by funding. If it does not happen, then to that extent loan also will not be released. So what I'm doing, along with working capital margin and preliminary pre-operative expenses, I'm also adding a component called contingency, which is 5% applied on building and plant and machinery. Okay, so 3 crore plus 6 crore, 9 crore. 9 crore into 5% is 0.45. So already we had how much? We had 11 crore. With 11 crore, this 0.45 is added. It means now the cost of the project is 11.45 crore. Remember, we started with 10 crore. Now it has become 11.45 crore. Okay, on this 70%, that is 3.44 crore is the capital which I should bring in, and bank will give me 8.02 crore. So look at this. In the previous stage, a capital contribution is 3.33 crore, but now we had reached a stage where the capital is 3.44. So at this point, the promoter will show his reluctance. Promoter will show his reluctance. What, I have come to you with a expectation of me bringing in only 3 crore and you giving 7 crore, and now you are asking me to bring in 3.44 crore. So that could be the reaction of the borrower. But here borrower have to be educated, and that's the need. If the borrower is not ready to understand, then he is digging grave for himself. Okay, because if he is not going to provide for contingency, if he is not going to provide for preliminary pre-operative expenses, if he is not going to provide for working capital margin, these are all the small things which can have big impact on the implementation of the project. Okay, so it's very important that they have to make arrangements, because it's not just the capital is increasing. Look, the term loan is also increasing. We started with a term loan of 7 crore, but now we have reached a stage where the term loan is 8.02 crore. So the bank exposure is also increasing by 1.02 crore. But unless and until banks takes this 1.02 crore, banks takes these three elements in the cost of project, bank is also digging grave for itself. Okay, so that's the level of importance. So here I cannot say that I will stop myself with 3 crore. Then if that is the case, it's better I drop this project. Okay, I can drop this project if I'm not in a position to manage this additional 44 lakhs. I can drop a project of 11.45 crore size because of my inability. Because if I'm not in a position to bring this, then it's better to drop. Do not undertake a big risk, because these are all small items, but they can have a big impact. Okay, next. The other element that should be considered in the cost of the project is interest during construction. This is also not prevalent in many of the private sector banks, but if you want to really safeguard yourself, if you want to really ensure that business, what your funding is taking off, consider this also. And this is very important, very important in case of new businesses which are going with their first project. What is this interest during construction? Let's take our case itself. What is the cost of the project? 11.45 crore. What is the term loan we have finalized at this stage? It is 8.02 crore. Okay. Now this loan has been sanctioned, and from next month onwards, EMI is started. So every month they have to pay interest and principal. But let's say this project is going to take 1 year for completion itself. Okay, so the cost of the project is 11.45 crore. The term loan required is 8.02. I'm making one rough assumption that the term loan is released in the beginning and they have brought in their capital. It means implementation period is 1 year, and for this 1 year they have to pay interest without any income. Why? It's only after 1 year they're going to start having their commercial operations. 1 year is implementation period, and for this 1 year period they're going to pay interest. How they will pay interest? They don't have income, they have only expense. How they will manage? That's where this concept of interest during construction comes into period. Let's say 12 months is an implementation period, then this loan amount into implementation period, that is 8.02 crore into 1 year. Okay, it's 1 year, right? Into 12%. 12% is the rate of interest I'm considering here. It means this 0.96 is something what they pay without having any income. How they will pay? They cannot pay. And if they don't pay, within a matter of 3 months, this account will become an NPA. So it is very important that this amount should also be considered as cost of project. This is not something propagated by me. Our banking system considers this also as cost of project. So already we had cost of project is 11.45 crore. Now with that, it's very important that this 0.96 crore is also included. It means what customer is supposed to pay is 0.96 crore. Now that is getting included in the cost of project. So the cost of project is 12.36, and bank is going to fund 70% out of it. It means now the term loan is increasing to 8.65. Earlier it was 8.02. Now it is 8.65. So 63 lakhs is coming from bank side itself to get their interest itself. But that is required. That's important if you really want to give appropriate oxygen, appropriate, say, the lifeblood for the business. Okay, so the term loan is getting increased on one side, and on the other side, of course, the balance money should come from the capital. It is 3.71 crore. So now a point has come where the borrower should realize that if he wants to go for this project, if he wants to take up this project, mere investment of 10 crore is not adequate. If he thinks that he can start this project with an investment of 10 crore, he is digging grave. Okay, he needs at least 12.36 crore to have this project implemented, and he cannot have this project done just by bringing in 3 crore. He should be mentally, financially prepared to bring in 3.71 crore, and that's good because term loan is also increasing from 7 crore to 8.65 crore. So if these factors are not considered in term financing, like IDC, interest during construction, contingency, preliminary pre-operative expenses, working capital margin, if you're not considering this, and if you're arriving at the cost of project and means of finance, it means what you are carrying or what you are preparing is an incomplete memorandum. Okay, it's not, I mean, you have not factored all the cost. I mean, see, what banks do is they freeze, or they will have a cap on the maximum loan they can give. So the bank or the branch will say, see, our maximum is 5 crore. We will give 5 crore. Balance you somehow manage. If that is going to be the approach, in that way, if you are going to give a loan to a project which demands 8.65 crore. So I'm talking with reference to the present scenario. See, this is a project which demands an investment of 12.36, and at 30-70 proportion, term loan required is 8.65 crore. So if this is the reality, and when the reality is like this, and as a banker, if you are going to say our bank sanctioning authority comfort level is only 5 crore, we will give 5 crore, you manage the balance, let's say 7.36 crore. If you are going to structure a term loan in this fashion, then that's the beginning of the end. That's the beginning of the end, because you are trying to give a half cylinder oxygen for a person who demands like 2-cylinder oxygen. Okay, you believe that by just giving half cylinder oxygen, he will start walk, run and fly, but he actually needs at least 2 cylinders of oxygen just to stand up. Okay, so that's the situation, that's the reality and background. Understand this. So never ever have a casual approach for a term loan. Do not just look at it as a uh, just one proposal. Do not look at it as just another proposal. Each and every term loan project or actually feeding multiple number of families. That's how I was trained. That's how I was given exposure. I mean, we never looked at term loan project as just another proposal. Each term loan is going to impact several thousands of lives at the time of project implementation and during the course of the life of the project. At the time of project implementation, the owners, the laborers, the stakeholders, the suppliers, okay, so many people are involved. It's going to have impact on their life, on their livelihood. And not only that, after the project, see how many employees, how many laborers are going to work in an organization. So if you take this role with the utmost care, because you are shaping a future of so many people. It's not mere a table where you put in some numbers and get the sanction. No, you are actually shaping a society itself. That's how I looked at term loan funding. I request whoever handles the term loan funding to have the same kind of approach, because it's not just one proposal. It's going to have impact on several lives. Okay, so this is something I wanted to touch on. Whether whatever I've explained was clear. I mean, if everything was going on perfect, and if you had some new learnings today, just type bulbo on bulb on. And I derive my happiness when I see so many bulb on here. Yeah, thank you. Thanks a lot. What you have seen now is only the tip of the iceberg. What you have seen now is only the tip of the iceberg. But the best part is you have understood whatever I have explained so far. Thank you very much. The reason why I say it's a tip of the iceberg is because in reality, when you do the credit appraisal, when you do the financial analysis, you have to read balance sheet line by line. You should focus or put your attention on every item in balance sheet. You have to analyze various set of financial ratios. There will be liquidity, solvency, profitability, return on investment ratios, various set of ratios. Then you have to study the cash flow statements in depth. You have to focus on item by item items. You should see where they generated money, where they have used, how they have used. Then you should also study their fund flow statement in depth, and again in between the lines, to identify whether any fund diversion have taken place. Then you should develop special skill for assessing the working capital requirement of the borrower. Here you got to empathize with the borrower, but at the same time you should also protect the bank's interest. Next, you should be able to put up a comprehensive loan proposal if a borrower comes for a term loan for putting up a project, because this requires viability study. You have to look into their repayment capacity, DSCR, fire, break even, sensitivity, and so on. Next, you should also be able to work seamlessly on CMA report, the basic Excel document which captures the past financial data as well as the current estimate and projection. And from this only all kind of analysis will happen. Next, you should be able to arrive at credit risk rating for the borrower. You should be able to come across different types of business entities, business models profile, and you should also be able to understand the forex impact on import export transactions. So what all this means? All this means you got to learn more, right? So how many of you are really ready to learn more? Because once again, I reiterate, what I have showed you today is only tip of the iceberg. So how many of you are interested in learning more? If you are really interested in learning more, if you want to take this journey to the next level, if you want to improve your skills that is required for your job, and that's the fundamental for your banking career, then type ILM. ILM stands for I am interested in learning more. ILM stands for I am interested in learning more. Whoever interested, please type ILM. Thank you very much. Can I have your permission to introduce the courses which I have published for bankers, which will solve all the problems we discussed? If you're permitting me, just type yes. Just type yes. I'll take that as your approval.
Financial and Credit Analysis Mastery Bundle. It's a bundle of course I have created for financial and credit analysis purposes. To start with, we have course number 1, our bestseller course, Banking Credit Analysis Process. By taking this course, you will get a complete picture of banking credit analysis process, starting with credit analysis, financial analysis, ratios, cash flows, fund flows, working capital, term loan, and so on. It's basically 30 plus sections, 200 plus lectures. This is one of our best selling course and it's included in this package. Then comes course number 2, how to carry out financial analysis as a banker. This course focuses exclusively on financial analysis, covering how to carry out financial analysis through ratios, fund flows, and cash flows. Then we have course number 3, how to carry out term loan appraisal and analysis as a banker. This is a course which is going to take you through the technical process of term loan appraisal and assessment, because here you have to understand the techno-economic viability of the project. You should arrive at the cost of project, means of finance that requires a different set of approach. You should understand the production factors of a project. You should understand the technical analysis involved in term loan appraisal and assessment, and this course will take you through that. Then we have course number 4, how to prepare CMA report for bank loan. CMA report is basically that Excel spreadsheet which is going to capture the past financials, present, estimate and future projections, and it's by looking at the indicators generated out of this CMA report, bankers are going to take critical decision. So in this course, through 8 sections, I have covered the CMA report preparation process in depth with an elaborate comprehensive case study. Then we have course number 5, how to read balance sheet. In this course, I have picked up a real life balance sheet from stock exchange and I have explained in and out of balance sheet reading process. By taking this course, you will develop confidence in reading balance sheet. Then comes course number 6, how to read CIBIL report. By taking this course, you will develop the ability to read the CIBIL report, read in between the lines, as well as read each and every line of CIBIL report and frame the credit opinion of the borrower. Then comes course number 7, how to prepare cash budget for bank loans. This course will help you when a borrower approaches you for short-term loans, ad hoc loans, or for letter of credit. So by taking this course, you will get the complete picture of cash budget with exposure to the format and solving real case studies. So it's basically 7 courses which I have introduced, and this 7 course package is what I call as Financial and Credit Analysis Mastery Bundle. And the price of this 7 courses works out to somewhere close to 13,000, but I'm going to give it at a discounted price for you today because you have attended this webinar, and the offer price what I give you is 4,990 rupees. Okay, but I'm not going to just stop with this. I'm going to give you more. I'm going to give you a lot more. I'm going to give you lots and lots of bonus. You are going to get course number 8, registration and licenses required to run business in India. It will take you through that entire process. Course number 9, how to carry out credit risk rating for non-trading entities. Course number 10, here you will learn banking credit analysis in depth once again through various case studies. So how many courses now? It's 10 courses of value close to 19,000 rupees, but you are not going to pay that amount. It's same 4,990. It means you get these 3 courses as bonus, but it is not just this. I'm going to give you some more bonus. Course number 11, financial statement analysis, a complete study. Course 12, master class on working capital management. Course 13, accounting and finance for bankers. Course 14, NPM management, a complete study. So how many courses? It's 14 courses of value close to 27,000, but I'm going to give it to you at the same price of 4,990. Not yet over, some more bonus. Here comes course number 15, where you will learn business finance secrets. So you will be wearing the hats of the entrepreneur so that you can understand the business finance secret process. Then comes the next course, finance for non-finance executives. This will be your savior if you are from non-finance background. Then we have the next course, basics of forex management, a complete study. This will save you if you're going to deal with import export customers. So how many courses now? It's 17 courses of value close to 33,000, but I'm offering it to you at the same price of 4,990. Not yet over, some more bonus. Here comes course number 18 for you, which is legal and regulatory aspects of banking, part 1 and part 2. And I'm also going to give you a course on accounting basics in 66 minutes and a course on fair practices code on lenders liability. So how many courses now? It's 21 courses of value close to 37,000, but I'm going to give it to you at the same price of 4,990. It means you get all these free, you get all these as bonus. But bonus not yet over, some more. You have the next course, that is basic elements related to bank loan proposal. This course will teach you how to write bank loan proposal. Then there is a course on credit policy, products, delivery, appraisal, risk and rating. Then you get access to the course called export finance, priority sector lending and retail loan. And you also get access to the course collateral securities, a comprehensive study. So how many courses? It's basically 25 courses, of which the 7 courses are main courses, and I'm giving you bonus. All the remaining courses comes to you as bonus because you have attended this webinar. So what is the overall value? The overall value is close to 45,000 of 25 courses. It's 3,200 plus lectures. You are going to get lifetime access to all these pre-recorded courses. You can access them in your mobile app, in desktop, and the price is close to 45,000, but you are going to get it for same 4,990, and it is not yet over, something more. I'm going to give you access to ebooks on current ratio, debt equity ratio, cash flow statement, capital structuring, financial break even, capital budgeting. So it's basically 12 ebooks you are going to get access. And I'm also going to give you access to certain e-resources. You will get access to project report template, CMA template. You will also get access to a template which you can use for planning your child's future education. And you will also get audiobook on types of financing. You will also get access to test series related to analysis of financial statements, working capital requirements, and ratio analysis. And something more, you will also get access to career guidance material which is related to professional courses for banking executives and a material on all about certified credit professional. So it's basically 25 courses of value close to 45,000, 3,200 plus lectures, 20 ebooks and resources of value close to 2,000 rupees. You get lifetime access for these pre-recorded courses and e-resources. You can access them in mobile app, desktop, laptop. Its value is close to 47,000, but you are going to get it today for 4,990 only. This is a one-time opportunity for you. Make use of this opportunity. Enroll now.
So thanks for this opportunity. I'm going to share the link. Please check your chat section. Whoever watching this in Zoom, check your chat section. Whoever watching this in YouTube, check the chat section as well as description below. I'm placing the link now, and this link is valid only for next 20 minutes. So if you want to continue your learning journey, if you want to take it to the next level, if you want to make best use of this opportunity, your time is on now. It's going to be next 20 minutes. So if you believe that this webinar has added value for you, and if you want to continue your learning journey, now the ball is in your court. Please click on the link. It will take you to the course. If you already have a student account in CA Raja classes, directly you can enroll. Otherwise, it will prompt you to open up a student account, and then you can complete the enrollment registration process. Let me also share some of the feedback given by our earlier students. Just have a look at it. If you still wonder whether you should enroll in this package or not, just look back your past 60 plus minutes you have spent. Just try to answer all the 4 questions. Question 1, did you really understood what was explained? If answer is yes, whether you are able to relate with the things that were explained in this webinar. If answer is yes, if you derived value in the 60 plus minutes, and if answer is yes, and if you had that aha moment or bulb on moment that you have learned something really meaningful, useful, then I would suggest go and enroll confidently, because you will get that throughout this package, throughout the courses. That's the assurance from my side. If you have this question as to how you can access these courses, just have a look at the screen. If you enroll now, you can access them in desktop, laptop by visiting our portal. You can also install our app. We have app for Android phone users as well as iPhone users. You can download the app from Play Store, App Store. Just search for CA Raja classes, and the courses whatever you enroll will be available in the app also. And the best part is you can download the courses into your mobile within the app, and you can access them later even without internet connection. After enrolling the course, if you have some doubts or if you need some guidance, we are going to provide you 24 by 7 lifetime support through our Telegram community. We have a community for financial analysis where 1000 plus bankers have already signed up. This is only for paid students who are coming to this specific course. You can ask all your questions and you will get reply. You can also learn from question answers of other participants. So now it's time for you to take your call. And before you take that final call, let me give you a bold assurance. My bold assurance is this course will deliver you at least 100 times value for the money you are going to commit. Yes, that's the kind of feedback I have received from earlier participants. That's the kind of upskilling happened for our earlier students. So if you want to get the best out of this, go ahead. And for you, it is not an expense, rather an investment. And what you're going to get is lifetime access to the courses, lifetime Q&A support through our Telegram community. You will not get such an opportunity anywhere or elsewhere. So make use of this opportunity. And whoever going to enroll now, please type I am enrolling. Please type I am enrolling, or in short, you can type IME. IME stands for I am enrolling. I'll stay back for next 10 minutes, and whoever completes their enrollment now, I'll be giving my live acknowledgement and assurance. So whoever enrolling now, please type IME.